Ganesh, it is 8 o'clock now.
Namaskar. Hello, good evening, everyone. And thank you all for coming to our Canadian Hindu Chamber of Commerce tax filing event. My name is Ganesh Parida. I am a director at CSCC and life member of the organization. I am excited to host this informative and interactive session. We will be hosting many seminars and workshops like this in the coming weeks. When you become a member, or more such events will be open to join and take part in. Now I am welcoming our President Naresh ji and both the speaker Bharat Chavda ji and Abhiram Sahu ji. Now I'll be handing over the mic to Marcy ji to start the process.
Thank you, Ganesh ji, and welcome everyone to the event. We're very happy to host this. Today we have two very special and very distinguished professional accountants with us who have years of experience working in the Canadian financial world and supporting businesses and corporations throughout their time. Our first speaker is Abhiram Sahu ji, highly accomplished financial executive consultant with over 10 plus years of experience working with startups, multi-million-dollar organizations, and corporations in Canada. He is a chartered accountant and a certified management accountant who has completed Masters of Commerce. We are just a quick request, please mute if anyone is not muted. Thank you. So Sahuji is a certified chartered accountant and a certified management accountant who has completed his Masters of Commerce. He will be talking today about the international taxation for Canadians with special reference to USA and India. I pass it to now Abhiram Sahuji.
Namaskar. Welcome to all of you. We selected this topic in our day-to-day practice. We see a lot of people and clients they have some sorts of tie-up, economic tie-up with USA and economic tie-up with India. And a lot of confusion comes when it comes to taxation. So we'll start from USA. For every Canadian, who has more than $100,000 assets anywhere other than Canada, need to declare that in their personal tax return. Then if we have personal property in USA or any asset in USA more than $100,000, we have to declare that in our personal tax return. If we have some personal property, like a lot of clients I have seen, a lot of Canadians, they have their own condo in Florida. They go there, they use it for their own family. They do not use it for commercial purposes or rental purpose. In that case, they do not need to file any income tax return in USA. If they have rental property in USA or the same condo which they are holding, they use it for a rental purpose, then they have to apply there for an ITIN. That is a temporary tax identity number in USA. And if it is held under a corporation, they have to apply for a number called EIN. The way we say in Canada business number, EIN number is employer's insurance number. So for that type of income, they have to file a tax called NR 1040 NR return to file in USA. Then some people are there, instead of holding the property or holding any business in their own name, they try to open a corporation in USA. So in USA, the corporations are two types. They are called C corporation or S corporation. C corporation means C corporation means it's like a Canadian corporation. What happens in corporations, first, how much income is there or any profit is there, that will be taxed in the corporate tax rate. Then from the corporation, if there is profit, it will be given dividend to the shareholders or the owners. And again, that dividend, what the owner is receiving, that will be taxed in his personal tax. That is what happens in Canadian corporations, and the exact system happens in USA for C corporations. But for S corporations, USA has a system. What happens is, if we select with IRA that this corporation will be reporting under C corporation provisions, then say $100,000 profit is there in the corporation and me and my wife are the shareholders, the corporation will not pay any tax. Corporation will only file the return that the corporation made $100,000, but corporation will not pay any tax to USA government on the name of, in the name of the corporation. What will happen? That $100,000 will be the personal income of me and my wife because we are the two shareholders. So that amount will be taxed. The corporation profit will be taxed at our individual capacity based on our shareholdings. If I hold 70% share, I will get $70,000 out of the $100,000 profit, and that $70,000 will be taxed in my personal tax, and $30,000 will be taxed in my wife's personal tax. That is how the S corporation taxation system works. Next slide, please. Next slide, you will go to Marcy. Next slide.
Yeah, it is there.
Yes. Second one. This is third one. We'll go to the second one. Yes. So if we have property more than $100,000, or if we have any income or any global income outside Canada, we need to file a special form here in Canada as Canadian citizen or PR or Canadian resident. That is called Form 1135, Foreign Income Verification Statement. That has to go along with our tax return. Then, say for example, I made $100,000. I'm a Canadian citizen, or I am a Canadian resident, but I have some business in USA and I made $100,000 profit. And based on my $100,000 profit, I paid in USA some taxes, say $25,000 tax I paid there. The same tax, now what will happen under tax return, when I file my return in Canada, I will declare that $100,000 as my global income. That will be added to my Canadian income. And at the same time, how much tax I have paid in USA, I have to file a form called T2209 here to get a credit from the federal government. And I'll file a form here, T2036, to get a credit from the Toronto. Ontario government will give me a credit and the federal government will give me a credit. So these forms have to be fine. Basically, a lot of people confuse. If I declare my USA income here, then I paid their tax, I will pay here tax, and all my money government will take. So a sort of manipulation or concealing tax starts from there. It is just a fear psychosis. It is not that. The law is very fair, and if we paid tax in USA, we will get credit here for that amount by the Canadian government. So we should not have that confusion in our mind. Then tax paid on capital gains. If except ordinary business income, if we made some capital gains in USA, say I purchased a condo or I purchased a house in USA and I sold it, $300,000 profit I made, that is a capital gain for me. So that capital gain tax, if I pay in USA, that we will get also credit in Canada. Tax withholding rate in USA for Canadian citizens is 15%. Normally, the USA tax rate for all the non-resident, with which country they do not have any treaty, tax treaty or DTAA, we say that is dual tax avoidance treaty. So if we do not have that, USA do not have that with any other country, the withholding rate is 30%. Any income you make in USA, people of those countries with who USA do not have tax treaty, they will withhold 30% of the income. But for Canadians, Canada and USA has a treaty and it has some special provisions. We for Canadian citizens, the withholding rate will be 15% in USA income. For less percentage of withholding, if something happens, means we know that we have to pay less tax in USA. In that case, we have to get a certificate of withholding to file with the IRA, Inland Revenue Agency, there in USA, and we will, before the date of the transaction, say for example, I want to sell my house there in USA. I based on my house value will be $100,000, $1 million. So 15% how tax they will hold. The buyer who is buying my house, who is paying me, he will pay me $850,000 and hold $150,000. That is 15% of my house value, which is not fair, because a lot of my money will be held by him. So what happens for that? I know I bought my house for $600,000. $400,000 is my capital gain. So if I pay tax on $400,000, it will be coming, even though 15% withholding, $60,000. $60,000 will be 6% withholding on my $1 million sale. So in that type of situations, the law provides, USA law provides us the opportunity. We will go ahead, make the calculation, submit a form with IRA, and IRA will give us a certificate of withholding at a lower tax rate, means a 6% tax rate withholding. So instead of holding all my $150,000, 15% on my whole house price, the buyer will hold only $60,000. This is how the tax system works there. If we provide a minimum tax holding certificate from the IRA, we file with the IRA, and the IRA will give us a certificate. We give that certificate to our buyer of the house, then we will be able to save a lot of money. Then when we file our taxes, if we are eligible to get any refund, we will get. Then we'll go to next slide, please. As I told, for ordinary non-resident, withholding rate is 30%. If because of US-Canada tax treaty, it is 15%. But in that case, we have to file a form that is called W8BEN. If we fill that form and file, then it will be 15% holding. It won't be more than that, because that form has conditions that we are filing that form under the US-Canada tax treaty. A lot of Canadian citizens are there. They invest in the stock market of USA, New York Stock Exchange, Chicago Mercantile Exchange, Chicago Stock Exchange, in mutual funds, in company stocks, and like that. For them, I would suggest definitely they should file the W8BEN form through their broker with IRA. Normally, broker will ask when you open the trading account, and you should renew that form every 3 years. Means update the form. Yes, my status is that, and I will continue with the W8BEN form. Then some special treatments are there. If somebody has a RRSP money and he wants to make it self-directed fund, what happens? Normally, when we do RRSP through bank has its own portfolio manager. They manage our funds. But also there is an option, you can make it self-directed fund. You can manage your own RRSP money. Normally, if somebody is 25 years old or 30 years old, he saves money in RRSP. By the time he draws in 65 years, there's a long period of time the money is lying there. So a lot of people who has little knowledge on investment, or they try to learn more about investment, they try to make it self-directed, and they want to manage their own funds. So in that case, the RRSP fund, RRIF, LIRA, LIF, LRIF, these type of funds are called registered funds. And if registered funds are invested in USA stock market or USA, and any profit is made, there is no withholding, and the way Canadian the income is treated in Canada, in the same way it will be treated in USA. So we do not have to pay any tax on those type of incomes under the umbrella of registered investment plan. Then portfolio interest income exempted from tax in USA. Portfolio interest income means sometimes the person or a lot of registered organizations are there. They buy US corporate bonds, US government bonds, treasury bonds, federal government bonds, provincial government bonds, city bonds. Those type of bonds get regular interest income. And for those type of interest income, it is exempted from tax in USA. Then capital gains on US corporations, shares, ADR, American Depository Receipts, ETFs, electronic traded funds. So there is 0% tax rate on tax withholding on those type of gains. We'll go to next slide. These are the couple of common situations. Normally people buy a property in USA, they invest some money in stock market. Based on that, this is what we provided. Now we'll go to India. So being majority of us who are participating, we are some way or other way originated to India. So some people have their assets. A lot of times we do see during our practice, people have their assets in India, like their house, their rental property. When they are settled here, they want to wind up that. They want to sell that and come here. And they confuse a lot. And a lot of fear, psychosis I have observed in those people. All money government will take. Everything will be taken by the government. I will pay tax there. I will pay tax here. If I declare all the money will be taken by the government. If I do not declare, how I will bring my money here? I have to find out some way how secretly I will bring my money here. All these things we can avoid legally, and we do not have to resort to that type of practice. We do not need it. Law is not that harsh. The law is very good. It is so if we have assets more than $100,000 in India, we need to declare that in our tax return here. And if we have income in India, then we can declare that under the form T1135, and we can file that form here. A rental, dividend, interest, salary, consulting, any such income we can declare here in Canada. And any tax we have paid in India, that also we can claim here as tax credit. Sometimes we get full credit as refund. Sometimes we do not get full credit, but the difference is very minimal. It's not that much somebody will be killed. No, there won't be financial killing if we declare it and if we go in the right way. Then transfer of money. When we transfer money, always we should resort to banks. Bank transfer, wire transfer, that type of transfer, we should follow that. A lot of other ways people try to follow, and it's not always good. And AML, the anti-money laundering scrutinization is very, it has started by all the banks, and it is nowadays it is really troublesome if you are caught in that. And we can avoid that. Why we have to take that risk, and why we have to go for that? We shouldn't. Then file income tax return in India, get the tax return a refund from the government of India. Normally, when we are here and we have some tax deduction, some people have their money sitting in the fixed deposit account like that. The bank deducts their taxes on the interest income, on the dividend income. And I always recommend, if you file tax in India, majority of the cases you will get a refund of those income. At least a part of that you will get refund. So people who do not file, they lose that benefit, but we should not lose that benefit. Next slide, please. Disposal of real estate. This is one of the most common, highly confused, highest discussed topic, and I want to throw some light on this. Disposal of real estate income, we need to pay capital gains in India. Capital gains calculation in India is little different. What happens is, say I purchased a property, I purchased a condo in Mumbai, say in 1980 I purchased. In 1980, what was the CPI, Consumer Price Index? Based on the inflation rate, the Consumer Price Index changes from year to year. So the value of 1980, say it was 5 lakh rupees. In 1980, what I purchased for 5 lakh rupees, first it will be indexed. What will be the value of that 5 lakh rupees today after factoring the inflation, the CPI as of today? And normally 5 lakh, if it was in 1980, it will be somewhere close to 50 lakh. So if I sell my condo for 60 lakhs today in Mumbai, then 10 lakh on 10 lakh will be my capital gain. On that, I have to pay tax, not on pay the entire 60 lakh. So this is how people come into confusion, and unnecessary fear, psychosis is created, and they try to resort to some practice which is not means they try to resort to some improper practice. It should not be there. Then when we transfer money, section 195 get lawyer deduction certificate. The way I told you, in USA we can apply for lawyer upholding, lawyer withholding of the taxes. The same way also in India we can calculate. We can go to a chartered accountant. He will calculate how much will be actual capital gain after indexing and after doing all these things. Then he will prepare a form and file it with the income tax department. There, the income tax officer will give us a certificate of minimum tax holding. So based on that certificate, the buyer who is buying our building or our condo in India, he will withhold that much. And it is his responsibility to deposit that money with the Indian income tax authority and give us the, if we are selling, we have to get that certificate, that is called Tds certificate. That Tds certificate we have to get from the buyer. Then we will file the tax in India and we will get our tax refund. Another thing, Government of India has given certain provisions. If we have some capital gain and we invest that capital gain, means I sold one house, I made there set 10 lakh in capital gains, and I invested that 10 lakh in another house in India, then I do not have to pay any tax under section 54 of Indian Income Tax Act. Then another provision also they have made, if how much capital gains we made, we invest that capital gains under section 54 EC. Section 54 EC means 2-3 types of specially recognized bonds are there. One of them is NHAI, National Highway Authority Bond. To create good highways, Government of India sells bonds. If we invest in that bond, or rural electrification bond, then we will get entire tax refund. We don't have to pay any tax. So what a better facility is there, and we unnecessarily take the fear out of ignorance, and we go on resorting into something improper practices, which we should not, from today onwards at least. Next slide, please. And when when we sell our property in India, the onus of tax collection is not ours. The onus is on the buyer who is buying our house. Say, for example, some buyer who does not know, and we sold the house and we came back. Later, Indian income tax authorities came to know that somebody has sold, a Canadian citizen has sold his house in India. Then they are not going to run behind me in Canada. They are going to catch the guy who bought our house. That is why the onus of compliance of these tax issues with the buyer, not with us, not with the seller of the house. Then short-term capital gains. In India, they have a specific definition. If you hold the asset at least 3 years or more than 3 years, then it will be considered as long-term capital gains. If you hold less than 3 years, then it will be considered as short-term capital gain. If it is considered as short-term capital gains, then the tax rate is slightly higher. Normally, some people from here, they do their trading in Bombay Stock Exchange. They do their trading in National Stock Exchange. They buy stocks, mutual funds in Indian companies, and they do invest through that. So those type of, if they sell within 3 years of time, normally that is considered as short-term capital gain. Then sometimes we, being Canadian or those who are in North America, we are approached by a lot of Indian organizations to donate them something. If we are donating, a lot of time you might have observed that, you might have observed that we write there for family maintenance. Normally, it is the easy way to write family maintenance because to pass through the legal process. But we should write we should ask the organization if they are registered with the RBI under FEMA, Foreign Exchange Management Act, then we should write we are donating them. In our transfer form, we can write we are donating them. Then we can receive gift from our India father, grandfather, anybody without any tax paying in Canada. Then payment of TDS in India, collect the TDS certificate and file the tax in India and get the refund. I conclude here my presentation. Then Bharatji will do his presentation. After that, the floor will be open for taking questions. If anybody has any questions, we will answer. Thank you.
Martiji, now if you can start my slides. Hello, namaste everyone, good evening. My name is Bharat Chawda, and I'll just taking this for initial immigrants and students in Canada. So we'll give idea about initial returns and all. Please change it to next slide. Next slide, please. So first question is, who need to file return? There are a lot of confusion around. Now let me give you idea who needs to file return in Canada. Now, first of all, if you have Canadian income or you have international income, then you need to file return. Now, another reason for filing return is if you owe any government money, if you need to pay tax, you need to file return. If you are eligible for getting refund, how you can get refund? By filing return. Now, there are other reasons also to file return. If you need to get GST, HST credit or Ontario Trillium benefits, you need to file return. Now, for student, it is very important that if they are studying here, they are paying university fees, they are paying fees to the college, they are getting tuition fee form. Now, tuition fee paid, that is given as a credit. When you file return, then that credit will be issued. So student, even if there is no income, even there is no refund for them, still it is important to file the return, because whenever there is a tuition fee, you file return, either you claim it or you can carry forward. Now, suppose you don't have any taxable income in current year, but probably you will have taxable income in the future years. So whenever there is a good income in the future, whenever you carry forward in the future year, then there will be a very handsome refund in the future. So don't forget to file your return. You need to file return even if there is no income. Now, there are a lot of confusion. Where I am a citizen, I am a resident, permanent resident from immigration perspective, I need to file return. No, it is based on the residency from the income tax definition. Now, if you are in Canada, if you have ties with the country, if you are earning some income in Canada, if you need to get some refund, if you need to get some credit, then you need to file return. But if you are just citizen, but if you're not in the country, if you are having a permanent resident status from immigration, but still you don't have income or you don't have any reason to file, there is no compulsion to file return. But it is always good to file return, because you never know, there may be some benefit, there may be some credits. So it is good to file a return as far as if you are having a ties or if you are having some reason to file a return in Canada. So it is not just only income, but for getting a credit also, you need to file your return. Marcy ji, please change next slide. So as we briefly touch, previous slide. Previous. Yes. So we touch who need to file return. Now, second is next slide. Marcy ji, next slide, please. Yes, this is the one. So tax credit and benefits. Now, when you file return, you are becoming eligible for getting various credits. Now, what credits we can get? First, there are a lot of credits. So one credit is GST, HST credit. Second, child benefit credit. Third, whenever you are working as a full-time or as an employee in any organization, you are getting one credit, Canada Worker Benefit That was earlier known as a working income tax benefit. So even if there is no tax paid, still you get credit and then you get refund. So it is necessary to get that Canada worker benefit, you need to file return. Another credit is Ontario Trillium benefit. Whenever you pay rent, there is a Ontario Trillium benefit, you can get it by filing return. Now, if you are senior and if you are not having a good income, or if you are expecting some benefits, you need to file return. For getting a Canada pension plan, old age security, guaranteed income supplement, you need to file return. Now, if you don't file return, you will not get benefit, because then it will stop from July onwards. So it is necessary to file return every year to get continuous benefit from the government. Student, naturally, we already discussed tuition fee. You can use it or you can carry forward in the next year. So majority of the benefit and credit are based on income and eligibility, often determined based on your income tax return. So naturally, you need to file return, and that in Canada, majority of the people are filing return because it is not just only tax return, it is income tax and benefit return. So that is why it is necessary to file return. Mercy ji, next slide, please. Now, what period we are covering for filing return? It is always from January 1st till 31st December. Now, what is the deadline? Deadline is for individual salaried people. If there is no business, 30th. If there is a sole proprietorship business, then 15 June. If there is a trust return or estate return, then the deadline is 31st March. Now, what type of income we need to declare? So this is not a complete list, but it is a major list. If you're working somewhere, there is a T4 received, you need to file return. If you're getting T4A for any scholarship, bursaries, grants, or you got some benefit from the government, like in a COVID year, people got the benefit because of the lockdown and all. So they normally got the T4A. So when you get T4A, you need to file. T5, investment income, even T3 also. There is a capital gain, there is a gain or loss in a share transaction. If you earn some income in a bank putting GIC, you need to file return. Now, if you are having some sole proprietorship or you are doing a real estate agency business, Uber, Skip the Dishes, there are a lot of businesses, but you need to file a return. Real estate rental income. So this is the all source of income you need to file return. Even if there is some income which is not listed here, and if it is not exempt, you need to file a return. Mercy ji, next slide, please. Now, what kind of deductions and credit we can get? So this is not an exhaustive list. We are just trying to cover basic because this is the short session, and then we are covering corporate as well as individual primary income filing requirements and all. So what deduction we can get it? One, tuition fee. Like whenever there is income, you can deduct tuition fee paid to any college or university, and you get refund, or you can carry forward tuition fee to the next year. Now, suppose you have OSAP loan or any bank loan, then that can be claimed as a interest paid on a student loan. If you are paying rent to your landlord, collect that rent receipt, and then that will be used for getting some credit. If you are making some donations to all charitable organizations, that charitable organization needs to be registered with the Canada Revenue Agency. So you can find by visiting CRA whether that organization is registered or not, and then there will be a charitable organization registration number listed on that receipt. So please collect that receipt, and then you can claim charitable donations. Medical expenses, there are a lot of medical expenses that can be claimed in your return. It can be for you, for your spouse, or your children. So make sure that that medical expenses qualifies for deductions. There may be some expenses not qualified. Like suppose you pick up some medicine from off the shelf, that may not be qualifying, but there are majority of the expenses qualifying medical expenses. If you are putting your child in some daycare, definitely you get deductions. So please collect their receipts, and then you can use it for your personal tax filing return. If you are making RRSP investment, yes, that can be claimed. If you are paying for membership, union fees, or dues, that can be claimed as a expenses. Now, initially, there was the paper filing for the first return. Whenever anyone is coming to country, they need to file paper return. But now CRA made changes. So now you can file your even first return also by e-file or net file. So majority of the return in Canada, that is normally done by e-file because it's the fast, quick. There is no problem in getting refund quickly. and data is 100% transmitted to the CRA. Now in our office, like we file only E-file, no paper returns by and large. Mercy, next slide, please. Now, what is the tax rate? So this is just giving idea about what is the federal tax rate and what is the Ontario tax rate. It is different for different provinces, but just giving idea about Ontario right now. So if you look at the first lab, like up to initial $13,000, there is no tax. But if you look at the initial first lab, around 49,000 in a federal, there is a 15%. And if you look at Ontario, it is 5%. So in other words, like if your income is around $45,000, $49,000, you are falling under 21% tax. And then rate will go up, and depending upon your extra income, you can just calculate your marginal tax. And overall tax, if your income is more than $250,000, then it will go up to 53% rate. So that is just get idea about rates. Next slide, Marshiji. So now we completed all primary information about personal and tax filing. Now I think once Mercy will complete a little bit of introduction about CHCC, and then we'll try to take all questions related to either corporation or bringing money from India or individual tax return filing. Then we'll go over and try to cover majority of the questions. Mercy.
Hello, Marcy.
Hello, sorry. Just thank you so much, Bharatji, for that section as well as Abhiramji. A little bit about Bharatji. He's a chartered professional accountant in Canada, also a CPA with the American Institute of Certified Public Accountants, USA. He completed his LLB and his MBA from India. He is working with various businesses and corporations for accounting, tax planning, HST return, payroll, and much more. So thank you, Bharatji, on the tax insight for students, newcomers, and immigrants. We really appreciate it. I'm just going to quickly share one more slide. As you can see, when you're a member or when you're taking part in CHCC events, you have the opportunity to take advantage of some of our seminars and stuff. And so there we are. So just wanted to really quickly go over with everyone on what are the benefits and what type of memberships we offer at the CHCC. So we have 4 types of memberships. We have the general, which is a yearly membership we have. We have the youth membership. So anyone age 24 or younger, please do get in contact with us. There's some amazing youth-related, startup-related events that we will be doing, something like this as well. We have lifetime memberships as well, and we have corporate memberships. Each one has its own benefits, as well as you get access to a wide range of support systems and databases we have. On top of that, all of our members have an amazing employment opportunities to trade shows. We'll be doing numerous workshops as well as seminars. Networking events, as the restrictions are rolling back, we'll be doing more in-person events as well. So you'll get an opportunity to see, beyond just the head, you'll get to see the other half, which will be awesome. We also have the monthly magazines that we will be starting soon. The yearly gala, which will be a great opportunity to meet people all across Canada who are all of our members and who will be coming into one place, and much more, a bit of surprise as it goes on. So if you want to become a member, you can contact me, Ganeshji, Nareshji, Kushagarji, any of the members, and we can for sure guide you on how to become a member. Social media is a great way to stay in contact with us. We are on Facebook, LinkedIn, Instagram, Twitter. Our email is one of the best ways you can always contact us, and our website is right here. It's with some of the most up-to-date information. So I wanted to just share now direct contact of our speakers today. Abhiramji, thank you so much once again for that insightful session. If you want to contact Abhiramji directly, this is his information. You can for sure email him, phone call him. He's always available to help support you and your business. And also want to take the chance to thank Bharatji for his time as well. And Bharatji's contact information and emails right there. You can always contact him. He's always available and he can help you and your business grow. So now it's the question and answer period. So we are opening up the floor. We would request that you write your questions in the chat, and then one of us can read your question out loud for the speakers. I think there's one question that we had was, how long can we carry forward our tuition waiver? If Bharatji or Abhiramji would.
Yes. Yeah, there is no restriction for transferring a tuition fee. So suppose you are in a country, you are paying a tuition fee for first year, second year, third year, fourth year. It can be definitely carried forward till you start working. And in the year of working, like whenever there is a taxable income, you can offset against the taxable income. Now that will be the first year you will be getting a big refund till the time you complete the whole credit, so that there is no restriction for carry forward. It will continue indefinitely.
Thank you. We have another question. If we give a gift from India, is it not added to the income?
No, it will not be added to income if it is gifted money. But get the money not in any improper way. Get it through wire transfer from bank to bank.
Absolutely.
And
we
I'll
just
tell
want to.
you, I'll tell you one more thing. DTA, some people, that is called trading of treaty or shopping of treaty. A lot of large companies, I'll tell you one example. India has a very nice tax treaty with Seychelles and Mauritius. We found a lot of companies across the globe, those who want to do business in India, they want to first open their corporation in Seychelles or Mauritius, and from there they want to redirect their money to invest in India and take the advantage of that. And some of those companies were caught by Indian what do we say, ROC, Registrar of Companies, and their license is being cancelled because their intention was malified. It was proved. So those things.
And he added to the question, is there any limit to the gift amount?
No, there is no limit.
Thank you. We actually have our very own new member, Badreji. He is joining us from Nunavut today. So just to Badreji, if you want to say namaste and hello.
Namaste.
Namaste and namaskaram to all. Yeah, I'm happy to be part of Canadian Chamber of Commerce Hindu. It is actually high in need here. Even though there are more than a million people out there, but we were never came under one umbrella or trying to identify ourselves. So just like how our India is so diverse, it is happy to see people from various background here. And I know personally Naresh ji, he helped me when I was in my student years. And I'm seeing him, I guess 2014 is where I saw him. Now I'm seeing him through this meet. So yeah, and more success. And it's happy to see and encouraging that professionals are coming out, and not just for money or just to give general advice or to bring in more people for a common cause here. I'm glad that I'm able to be a part today. Dhanyavad.
Thank you for joining us.
Thank you, Badriji. We have member almost across the Canada now.
Across the Canada.
Okay. Next question.
Yes, we have a question. If someone donates to the Indian Army, is that can we tax it? Can we get a tax return on it in Canada?
See, in getting a tax refund in Canada, what is requirement? First, it is to be done through proper organization, like that organization listed as a charitable organization in Canada Revenue Agency. There are few international organizations also listed in that website. So suppose you are giving donation to some organization which is listed in Canada as well as in the international. Also, by donating to a local charity, you can get deductions. So when you want to make sure that whether it is a deductible or not, just visit CRA website. You will find name of the charities. You can find even their charitable registration number also. You can look at their how much they are doing under what activities. So all information is listed in CRA website. So essentially, when you are donating to Canadian charities, and if it is registered with the CRA, yes, it is deductible. But if it is outside of the country, then not sure. You need to make sure that it is registered with the locally. Otherwise, there may be, if it is a small amount, it will not come under radar, but definitely it will not be deductible expenses in Canadian tax return.
Absolutely. Thank you, Bharatji. There's some amazing questions. Just a quick reminder, if we can get to them, we are copying the questions and we will forward it to Abhiramji and Bharatji, and they will get back to you. And we will also provide you with both of their information that you can contact them directly as well. As I can see, some questions are very detailed and specific. I see someone has said, they purchased a residential home in India in 1991, and their price was 200K, and currently the market value is 35 lakh. Do we need to file the T1 135?
If it is residential, you may not file it. If it is used for residential purposes, like your own relative or your family members, or when you go there, you are residing. But if you are using it for rental purpose and any income you are making, then it is wise to file.
Now, let me add one more thing in that response Abhiramji given that. Now, whenever any property is in India, when it is used for your purpose or for your relatives, or it is for your vacation, even if you are not living regularly, you don't need to declare it. Now, suppose, for example, that property value is rented out and value is $200,000. And then if you have that cost price more than $200,000, naturally you need to declare it. Now, why you need to declare it? Because when you bought it, that cost price is $200,000. Now 35 lakhs, that is less than $100,000, but your cost is definitely more than $200,000. It is good to declare. Reason being, whenever you sell that property, like 200,000 Canadian dollar, now it is less than 100,000 Canadian dollar, because you are losing $100,000. Why you want to lose your capital loss? So definitely good to declare. At the same time, like you need to make sure first, like cost price is more than 200,000 when you entered in the Canada, or if you bought it more than $200,000 and it is not personal use property. So yes, it is good to declare, but there is not much tax implication if it is properly planned, properly disposed of on a timely basis, and properly disclosed in your return.
Thank you. We have a question. I purchased a condo 4 years ago for one of my sons for education, and now I want to transfer in the name of another son as a primary resident. What is a tax liability in Ontario? And they don't want to sell the property.
If you do assignment and register at cost, assignment at cost, then there should not be any tax implication for you, because you are assigning it at cost price. So when the person, say for example, $300,000, you bought the condo, and today after 4 years, you are assigning from one son to another son at cost price. It means it will be considered as a deemed disposition at cost price. So you do not have to pay any tax. However, when your son disposes that whole amount will be considered as tax. But if it is used for personal, means principal residence, you do not have to pay any tax. Is it clear?
I hope the individuals are noting it down. We also have another question. Do I get any relocation expense benefits in taxing when I'm tax filing from US to Canada, for example?
Abhiramji, if you want to answer that
Yes.
question.
Relocation expenses are allowed within Canada. From USA, if you come to Canada for working only for employment or something like that, then you can claim it as employment expenses. A part of your employment income can be offset against that. To objectively answer, yes.
Okay.
Thank you. We have if Canadians pay tax in India on their property in India and get returns in India, then can they get tax benefit in Canada as well?
Wait, the question is here a little tricky to understand. Say, for example, you have a condo in Mumbai, very highly property tax is paid there, municipal tax especially, and you paid municipal tax there. So out of your rental income, you already, that was deducted as your expenses. So how much is in net income you are getting, net rental income, you are paying tax on that in India. So that net rental income will be added to your income here in Canada, and how much tax you paid on that net rental income, that against that tax you will be able to apply and get the tax credit in Canada, both federal and provincial tax credit.
Thank you. We have a few more. People are saying thank you for the answers and responses. It's very insightful and helpful. How do I transfer India's PPF account money to Canada?
Cash it. There is no treaty to transfer registered fund to registered fund. Say, for example, between USA and Canada, the way I told RRSP money, if you invest in USA, you can do that because it is under the umbrella of RRSP. It's a registered fund, and tax treaty is there between between Canada and USA. That is doable. But Indian Provident Fund money to transfer to Canada, for my knowledge, there is no treaty. I will try to give again another in look, but I know for my knowledge there is no treaty to transfer the register. That is a fund like RRSP here, right? So that fund under the same umbrella can be transferred here and added to my RRSP or something. That is not there.
Thank you. Is there any way to avoid capital gain tax?
Bharatji.
This is open-end question. So like we need more information. So there is no answer yes or no. It depends on the circumstances. So we need to know more information. Like there is no blindly you can avoid anything, but we need to know more information. Like if they can give some circumstances, then we can guide more.
During my presentation, I highlighted one thing, especially in relation to India. If you are making some capital gains in India and you do not want to pay any tax on that, you have to take advantage of Section 54 of Indian Income Tax Act. Means that money has to be invested there in another capital asset, the gain. Say 1 crore rupees, you sold 1 crore rupees. Fine. Now, after indexing, you bought it for 30 lakhs. After indexing, it becomes say 70 lakhs. So 30 lakhs is your capital gain. That 30 lakhs, you have to invest in another house in India or another capital asset in India. Then whatever tax you was withhold, you will get everything refund. Indian government will refund you all that. Alternatively, if you want to keep it in liquid asset, you have to invest it in, as I told, Section 54 EC benefit you have to take. That is, you will buy the bonds of National Highway Authority of India. Government of India is selling bonds to develop the highways in India. So if you buy out of your capital gains those bonds, whatever tax you have paid, government will refund it to you. Or if you buy the bonds for rural electrification bonds of Government of India, they are selling for the rural electrification in India. They are selling, they need a lot of money. That's why they are selling a special type of bonds. If you invest your money in that bonds, then definitely you will get all your tax refund, whatever you have paid to the government as capital gain, or the buyer has deducted from your sale price, that all you will get back.
Okay.
Thank you. There's again a lot of great questions. Best way to understand your situation is if you go directly and talk to Abhiramji or Bharatji directly, and I have provided both of their direct numbers and phone numbers, and I will also be emailing the card, so you have their information directly. You can always contact them, so your specific question or concern is answered in the best way. I do want to mention this session is being recorded and it is live on Facebook and YouTube. So if tomorrow you're like, what was the answer to that question, or how did we want to process, you can always refer back and always check on our social media to get all that information. So there's just about 5 minutes left. So we just really want to thank both the speakers, and I want to invite our a committee member as well as the director, Ashutosh Singh ji, to please wrap up our event for today.
Ashutosh ji, unmute, please.
Namaskar, everyone. That concludes the event for today. And a special thanks to our speakers, very professional and talented speakers, Aviram Shahu ji and Bharat Chawda ji, for such an insightful session. Thanks to all our guests who are joining us from all across Canada, coast to coast to coast. We at Canadian Hindu Chamber of Commerce are just getting started. There are many more things to come. Please visit our online website, cscconline.ca, and join as a member. Thank you, everyone, and have a great evening. And before I finish this, I would like to mention Ms. Pratha for her talented designing of our flyers. Thank you, Pratha. Thanks for doing our flyers for us today. Thank you very much, everyone. Have a good evening.
Just a quick request, the speakers and the committee members, if you can stay back just for 2 minutes so we can get a quick screenshot picture.
Okay.